The ebb and flow of global stock markets often mirror the intricate dance between economic indicators and investor sentiment. This week, Asian markets surged in response to Wall Street's positive momentum, driven by unexpected optimism from U.S. unemployment data. Such developments temporarily eased fears of an economic slowdown, which had been exacerbated by weaker employment figures earlier in the week. However, the volatility in the markets is a stark reminder of the fragile nature of the global economy, where a single report can sway investor confidence and market outcomes. As we navigate this economic uncertainty, one must ponder, how long can positive data shield us from the broader economic challenges that lie ahead? In the unpredictable world of global finance, market movements are often dictated by a complex interplay of economic data, investor sentiment, and broader geopolitical factors. This week, Asian stocks experienced an upward trajectory, largely tracking the gains seen in the U.S. stock markets. The catalyst? A surprisingly positive report on U.S. unemployment, which provided a much-needed reprieve from the prevailing concerns over a slowing economy. The latest figures from Wall Street showed a sharp rally on Thursday, with the S&P 500 climbing 2.3%, its best day since 2022, while the Dow Jones Industrial Average rose 1.8% and the Nasdaq Composite jumped 2.9%. These gains came after a better-than-expected report on U.S. unemployment, which indicated that fewer workers applied for unemployment benefits last week than economists had anticipated. This data was enough to calm jittery investors who had been worried about the potential impact of sustained high interest rates by the Federal Reserve. However, the week did not start on such a positive note. Earlier, weaker-than-expected employment data from the U.S. had triggered a wave of anxiety across global markets. Investors were particularly concerned that the Federal Reserve's commitment to high interest rates could stifle economic growth, potentially tipping the economy into a recession. This led to a significant sell-off in global markets, with the declines further amplified by the unwinding of yen-carry trade positions, a strategy where investors borrow yen at low interest rates to invest in higher-yielding assets abroad. In Tokyo, the Nikkei 225 index ended Friday 0.6% higher at 35,025.0, although the momentum was somewhat dampened as the yen erased earlier losses and continued its fourth consecutive day of gains against the dollar. This currency movement often negatively impacts Japanese equities, as a stronger yen makes Japanese exports less competitive on the global stage. Elsewhere in Asia, markets responded with varied optimism. The Hang Seng Index in Hong Kong gained 1.3% closing at 17,117.3, while the Shanghai Composite Index edged down slightly by 0.1% to 2867.21. In South Korea, the Kospi jumped 1.2% to end at 2,588.43, and Australia's S&P/ASX 200 advanced by 1.3% to 7,777.70. Taiwan's TAIEX saw a notable rise of 2.9%, buoyed by a 4.2% gain in Taiwan's semiconductor manufacturing company, which followed the rally of big tech stocks on Wall Street. The SAT index in Bangkok also saw a modest increase of 0.1%. The broader economic landscape, however, remains fraught with uncertainty. China's inflation data for July revealed a consumer price index increase of 0.5% compared to the same period a year earlier, driven by rising food prices. This was higher than expected and indicated that inflationary pressures, which had been subdued by flat food prices last month, could be re-emerging. This development adds another layer of complexity to China's economic outlook, which is already under strain from slow domestic demand and a challenging external environment. Despite these gains, it's important to recognize that the S&P 500 is still down nearly 10% from its all-time high set just last month. Such fluctuations are not uncommon, with corrections of 10% or more happening roughly every year or two. Thursday's rally has brought the index to within about 6% of its record, but the market's recent swings suggest that this is more of a positioning-driven crash rather than the beginning of a prolonged downturn. Strategists at BNP Paribas liken this to the flash crash of 2010, rather than the more systemic crises seen in 2008 or 2020. Amidst this volatility, companies continue to report earnings that are mostly better than expected, providing some support to the markets. Notably, pharmaceutical giant Eli Lilly saw its stock jump 9.5% after reporting stronger than expected profits and revenues, driven by booming sales of its diabetes treatment, Mounjaro, and weight loss drug Zepbound. The company also raised its financial forecast for the year, further boosting investor confidence. In the bond market, Treasury yields also climbed, reflecting a more optimistic outlook among investors. The yield on the 10-year Treasury rose to 3.99% from 3.95% the previous day, signaling a degree of confidence in the economic recovery. Energy markets, however, showed mixed results. Benchmark U.S. crude oil prices edged up by just 1 cent to $76.20 a barrel, while Brent crude, the international standard, fell by 7 cents to $79.90 a barrel. These minor movements in energy prices underscore the delicate balance between supply concerns and demand uncertainties that continue to influence the global energy market. As we reflect on the week's market movements, it's clear that investor sentiment remains highly sensitive to economic data and central bank policies. The question that looms large is whether this newfound optimism will be sustained or if it's merely a temporary respite in a broader trend of economic uncertainty. How do you perceive the current economic climate? Are we on the brink of a sustained recovery, or are these gains just the calm before the storm? Share your thoughts on what the future holds for global markets.